After a ripping rebound rally based on a resilient economy and a trade war de-escalation, how does the risk-reward setup for stocks look from here, and what will drive the next notable move? Here to get into all that are Dan Greenhaus from Solus Alternative Asset Management, CNBC contributor Stephanie Link of Hightower Advisors, and Stephanie Aliaga, JPMorgan Asset Management Global Market Strategist. Welcome. Great to have you all here. Dan, I'll just start with you. I mean, obviously, can't make too much of a fuss over a flattish market, but I do think a lot of the handicappers were saying, look, if we get a really cool CPI, that's an accelerant to the upside here. We have been up 3 days in a row, 2 weeks in a row. We're up 25% in 2 months, as I said. But how do you think the market's digesting all this?
I think what you just laid out there is exactly right. It was a pretty good inflation report. I don't think there's any other way to argue for it. At the same time, with respect to your points about the market being up considerably over the last couple of weeks and months, a lot of this was probably in the price because there were a lot of people out there saying, you know, this report's probably too soon to see the full effects of the tariffs. Remember, companies pulled forward a lot of inventory ordering, and so they're going to work down those first. At least initially, maybe they're going to eat some of these tariffs to see how long they last. So I think you really, and this is a point I've been making on air for some time now, you really need to get later into the summer, even the end of the summer, before whatever effects you are going to see will be seen in the report. I think with respect to the markets being flat today, that probably explains all of that together, some of what we're seeing.
Stephanie Link, we got some of the kind of after-the-fact explanations of why you did undershoot on CPI and maybe what it could mean in terms of, yes, maybe obviously we had to pull forward in January and February of some demand and pricing. It kind of gave way the next couple of months. The other piece of it is maybe demand's just not there where you can necessarily take price if you're a business. And then I guess there's the idea that the market is just going to be in suspense for longer, and it's just going to assume it's going to show up down the road and not going to give credit just right away. So how would you think about those things?
We're up 23% from the April lows, so a lot of good news is priced in. Yeah. That being said, we're checking off the boxes one by one. Inflation. Okay, I look at the headline just as comparing it to the 9% CPI number we saw 2 years ago. It's now at 2.1%. I look at the Atlanta Fed tracker. I'm not looking at 3.8% and thinking that that's a legit number, but average the first quarter and the second quarter, and you're running at like 2%. And the consumption is actually holding in. So the consumer is holding in. You have business equipment investments more than holding in. Yes, maybe that was a little bit pull forward, but still up 22% is very robust. And then to the extent we get any clarity on the tariffs, which we are getting, that all of these things set up for a higher market because all of it means better earnings. We're just not in earnings season right now. Yeah. So we're now hostage to kind of the macro and after a really big run. So I think you want to look for opportunities to be buying and to be buying some of the laggards like you mentioned.